financial markets and the CBOE for putting all this together. These kind of resources for local governments to be able to have information available it's really, really valuable. And so we're thankful so much for all of you making the time to make this presentation today. We thank our local legislators who we've invited, who are present, as well as our local media sources who are very interested in learning also about what our potential options might be to mitigate our fuel prices, and in this context, with respect to our LEAC, our levelized energy adjustment costs on the billing. So thank you so much for being with us here today.
Great. Well, it's a pleasure to be here. So what I'm going to do, it's 6:10 right now, and I'm going to speak probably for about 25-30 minutes and just give you sort of an overview and get, not too granular. I wouldn't want to put you to sleep, but I'm going to just present to you some of the strategies that utilities use to control costs so that therefore they can pass those savings on to their customers. And so what I'm going to do is I'm going to share the screen, and let me do this. And so you're going to see the screen share, and there we are. Now we're going to view, and we're letting somebody else in. Let's see, view presentation. Okay, slideshow. All right. And there we go. And okay, so it's a great cover page here, and I welcome everyone who is attending. And I hope that in the next half hour we'll be able to cover some information that's important to you. But before I get started, I'd like to introduce to you, we have two people who are very important to the development of this program. The first is Kyle Glenn, who's with the Futures Industry Association, and also my good colleague, friend, and fearless leader at the Institute for Financial Markets is Trish Fauché, who is also on the call. And she is the president of the Institute for Financial Markets, who I've had a chance to work with for several years now. This, I don't know if you, Kyle, if you want to say a few words, or Trish, you want to say hello?
Hi, Congressman Kyle Glenn with FIA. I just really wanted to say thank you and your staff for reaching out to us. We're based in DC, and we're the leading global trade organization for the futures, options, and centrally cleared derivatives markets. And we're fortunate to have IFM as a nonpartisan, non-profit educational foundation that's an affiliate of FIA. So we're always happy to be a resource to you and your colleagues up on Capitol Hill, and it's great to meet some new friends in Guam as well. So thank you so much for bringing us together.
I will echo that. Thank you to all of you for joining us today. Also, I would mention that we're appreciative of the CFTC, the Commodities Futures Trading Commission, which is the regulator for this market, for making the introduction of both FIA and IFM. We work very closely with the CFTC as well as other international regulators, and we value being an independent, nonpartisan resource for you. So enjoy the program. We'll have some follow-up materials that Congressman San Nicolas' office will be providing for you after the program as well. Thank you so much.
Yeah, thank you, Trish. Thanks, Kyle. So this is just about us. We've just now learned about the IFM, but just a little bit about myself. I started out learning about derivatives when they started to change the accounting for derivatives about 25 years ago. It was around the time of the Enron collapse and just the lack of transparency in derivatives. So I was working on the accounting standards, and then I became a consultant and started to consult to energy companies in addition to financial institutions and real estate investment trusts, and that was at Chatham. I was then called about 15 years ago to consider working with the public utility here in the Washington, D.C. area where I live. And the reason they needed help is that they really had a very disorganized hedging program. In fact, they were really speculating more than they were hedging, and it was they needed someone, and it was their auditors that forced them to hire someone, and that someone became me. And I've been an entrepreneur, but just by by my background and experience. I've been very entrepreneurial in my way, and I dove in there and I learned that there was no order. It was there were contracts everywhere for natural gas delivery. There was no organization. There was one guy with a telephone to Wall Street, and he was doing hedging deals. And the people at Deloitte were really getting very upset about this because we had this new accounting standard where you're marking to market these derivatives contracts, and things were very unpredictable. So they really needed some structure and some order. And they hired me, and then I in turn hired a department and just created order around hedging the strategies, working with the treasury management, the CFO, the controller, really bringing all the leaders together to agree to the strategies. And so I feel very comfortable in talking to you about what a public utility needs to do when it comes to strategies for maintaining a cost structure to benefit your ultimate customers that are buying power from you. So my background is primarily in natural gas, but I've also had some experience at Washington Gas working with electricity contracts that we also provided through WGL Energy Services. After Dodd-Frank, I worked with Fannie Mae and Freddie Mac in transitioning to greater transparencies in the swaps market, which is also now a part of the oversight of the CFTC, the Commodity Futures Trading Commission, that monitors both futures options and now swaps. So a little bit about myself. Let's move on to what we hope to do here today is give you just sort of a high-level overview of what has to happen within the public utility, or really within any organization when it comes to controlling risk. And then we'll talk about what kinds of tools are out there and provided through the futures markets. And I'm going to talk more specifically about some hedging strategies, things I'd like to recommend that a utility consider as the best way to control commodity price risk. And while I'm an educator, I'm also a consultant, and I've helped companies manage commodity price risk and interest rate risk. So, it's something that I'm familiar with, and I'll share with you tonight. And then we'll close on some of other additional educational resources that you and your team and the people at the utility might find useful. So, just for starters, okay, you can see through the gray box in the center is treasury. We'll just call that treasury management, and every organization has a treasury management. Now, treasury management does a lot of things. I mean, a portion of treasury management makes sure that there's payroll, so that when employees get paid, you actually have resources there that are backing those paychecks. But treasury management is also an area that covers risk management. And the idea is that you want to protect and preserve the enterprise. And you do that through commodity price risk management. You can also work with interest rate risk or foreign exchange risk. These are extraneous risks that no one has really any control of. And so to preserve and to protect the value of the enterprise, you need to focus on these areas that are outside of your control and use tools that the market can provide to you to control that risk, so that you have a predictable cost structure. And we'll get into the products that are available for you to do that. The other side of treasury management that's important for you to know is this cash and liquidity management, debt management, and investment management that we consider all in the supply chain. Now, it's important that information comes from the supply chain management structure into the risk management structure, and that they work together to establish strategies for managing risk. Either part can't work in a vacuum. They really need to work together. And my emphasis here is really to look at strategies for rate risk management. So there is a program called Enterprise Risk Management, or ERM, and it's a part of the corporate governance, and sort of came around about, say, 25, 30 years ago. It became very popular, Enterprise Risk Management. And it's a program of management structure that identify strategically, what risks are acceptable to the organization. And that's what they call establishing a risk appetite. So inevitably, you're going to have to deal with a certain set of risks that get presented to you in a changing marketplace. And it's up to the corporate governance of an organization to set that risk appetite. And that risk appetite might be one that, as the congressman was talking about a few minutes ago, is that, we have consumers that are paying a tremendous margin, for their electric bills. And so what really is, that seems unacceptable, right? So what is acceptable? What can we live with? And so we set goals and targets and based on our appetite in the risk management strategy, sort of the next level. The risk management and governance, our oversight of it, deals with the execution then, and the risk model depends on different data sets and market structure that incorporates the governance of the system that you put in place. So you've got this enterprise risk management program that takes into account these four elements. And with that structure, you're going to look at what types of exposure does the enterprise have, does the utility have, do we aggregate that exposure? Is it from different parts of the enterprise? And we can address that exposure in the model, in the governance, and we can deploy a strategy. And that would be, it's a hedge execution strategy. And then, this is where you bring into account the futures, options, swaps that might be used in executing those hedges. And then you look back and you apply a risk mitigation or performance assessment. Did we achieve what we were set out to achieve in our risk management strategy in accordance with the governance that's set forth in the program? So you see there's quite a lot to it, and it isn't going to be reliant on one or two people. There really requires a team of people and leadership and engagement, because it's not something that you can just execute one day and walk away from. In fact, a hedging program has to be monitored on a day-to-day basis because the markets are that volatile, and it really needs to be carefully managed. So what happens when commodity prices change? So when there are commodity prices that change, they send a ripple effect through the organization. And it affects your forecasts and your capacity to be able to control what the outcome is of the organization. And in the case of a public utility, the ultimate cost of power that unfortunately is passed on. If it's not controlled, then the consumers have to pay that cost. So in the case of a volatile market and changes in commodity, let's say there is a fall in the commodity price. And we're just looking at the far left-hand column. There's a fall in the commodity price. If you're an organization that's holding inventory, the inventory will have cost you at a higher level than what the market will bear currently for that particular commodity. And so organizations that hold an inventory of the commodity, they're going to have lower sales. That is, it's going to be lower income, and that, of course, affects the profitability. Now, why is that a problem? Because profitability is closely linked to sustainability of the company. And if there is a fall in commodity price also, you run into a problem with the capacity to be able to purchase going forward, just to plan in terms of your purchases. If your profitability is off, what's your capacity to move forward as an organization? That gets stressed. And then finally, their earnings in a falling commodity price market, your earnings are going to be below what's expected, and sales are going to be lower, and you're going to see a sort of fallout of earnings and income for the enterprise. Conversely, a rise in commodity prices, that's not always good news. You've got a lower cost of inventory, which leads to increases in cash flow. Okay, that's great. If you're looking to generate income through rising commodity prices, but you've got increased sales, but you've got further decreased purchasing power if you've got to go out to the marketplace to actually buy more commodity to sell. So your values, as it says in the earnings column, the far right, net realizable values at above cost, sales realizes are at the same, and so you have higher and higher, lower, thereby increased earnings. So whether there's a fall in commodity price or a rise in commodity price, the idea is that neither uncontrolled is very good for an enterprise, because what you get paid for as an executive, as a manager of an enterprise, is for you to meet forecasts, is to demonstrate that you can manage an enterprise so that it's sustainable and predictable, and that includes the capacity to be able to pass on to customers prices for power that are manageable and within that risk appetite that was set by the governance of the enterprise. So tools are available for organizations to use, and they're available through the futures market. So the futures market, or the futures exchange, is a central financial exchange where organizations, including power companies, can buy and sell derivative products at a predetermined price for delivery at a specified future date. So the prices that you see that are listed by these exchanges are the expected price a month from now, 2 months from now, 3 months from now, 4 months from now, and they can go out 12 months, 24 months, 36 months, depending on the different type of commodity that's traded. But there are hundreds of different commodities that are listed on these exchange markets. And each one of them offers a buyer for every seller and a seller for every buyer, and clearing that is guaranteed to settle, so that your organization or utility is not exposed to any risk of counterparties failing to perform as expected. So the futures market is a place to go for a number of different sources of power types, power commodity related to whether it be fuel, gasoline, crude oil, just the whole myriad of energy commodity. So who relies on this? Well, you've got the producers, the wells, the oil companies rely on these exchanges. Dealers, those are the intermediaries, distributors, the intermediaries, and as well as investors. So they use these exchanges as a means to reduce price risk, to reduce the volatility, and also to forecast the supply and demand that they're going to need to accommodate, in the case of a utility, accommodate the demands and the needs of the region in which you are contracted to serve. And the other important reason for these exchanges is also to plan for future infrastructure investments, to construct a power company, any energy plant. The forecasts are going to rely on what the traded prices are for the commodities. So if the power plant is expected to generate, let's say, low sulfur diesel power, then where do we look for to forecast how much production will that create? What will the price be on that low sulfur diesel? Well, you can see it because it's traded on the exchange. It's a liquid global contract. And so that's the kind of assurances that bond underwriters, municipal bond underwriters, banks like to see in terms of underwriting a power plant construction project. So these exchanges provide a great deal of information for not just hedging, but also managing the price demand, as well as the development of infrastructure and the construction that's associated with building these energy companies. So if we think about the futures markets, these are central marketplaces. So these are central located in US as well as other parts of the world and traded globally. And so the buyers and the sellers of a particular commodity are the ones that determine the prices. The exchanges simply offer the platform for which they can trade. They think of these exchanges as big technology companies that permit buyers and sellers to come and immediately transact with one another and settle immediately on futures and options or swap contracts. So these buyers and sellers then have not only an opportunity to determine what the price is by looking at where the exchange is trading, but also to plan on future delivery. The future delivery can be accommodated by the exchanges through their clearinghouses. So their mission is dual, both price discovery as well as for delivery. So they're considered critical to the economy as they look to predict prices. So if you're going to be looking down the road and trying to predict what you're going to charge to customers, the best place to go would be to look at the futures contract prices that are priced in sequential months. And you'll see that if you're reliant on crude oil, for example, for a utility company, you can gauge then what the cost of that crude oil is going to be looking at the futures contract price, and entering into that contract, you can lock in that futures price for forward delivery. So if you're a utility, you're going to be a hedger. That is that you're offsetting the price risk in the market, forward delivery. So you're long the contract to protect yourself from rising prices. And there are other parties in the marketplace called speculators, and they have a view as to whether the market is going to go up or down, and they're strictly in the business for generating profits from entering into a futures contract, low or high, and exiting out just to generate a return. But hedgers are looking for a way to protect themselves. Of course, this is exactly what the utility company wants to do. They want to protect themselves from having to experience high energy costs. They want to protect the consumers from having to pay for anything that is volatile in the marketplace and these large power bills. So there are a number of exchanges that you can work with. And of course, the largest ones that we know here in the States are, the CME and the Intercontinental Exchange, but there are a variety of them, and you'll see that there are a number that are in the Pacific region with the Australian Exchange. You've got Shanghai. There's also Singapore, that's GX. There are Korea Exchange, Tokyo Commodity Exchange. So there are active markets that are near Guam. And that the reason that is relevant is that if there are power or energy contracts that are exchanged through those venues, then the locality in which delivery is provided is going to be closer to the locality, of course, where Guam is, and that is one consideration if you're planning a strategy at the utility as to which exchange really makes the best sense given the exposure that the utility in Guam has. So just a little background of sort of the oversight of this industry. It started with the Congress and the legislation being the Commodity Futures, the Commodity Exchange Act that was passed in 1936 that governs the oversight of this industry. It's been updated many times. The most recent that has probably most dramatically changing Commodity Exchange Act was the Dodd-Frank Act, which brought swaps as well as margining and swaps along with futures and options under the Commodities Exchange Act. From the legislation, we have the regulator that was put in place in the 1970s. The regulator became the Commodity Futures Trading Commission, or CFTC, And a few years later, in the early 80s, the NFA became the Registered Futures Association that works with the CFTC in the oversight of this industry. And then finally, the futures exchanges are also critical to the oversight of the industry, and they really keep everyone in line, making sure that they're following all the rules that are established in order to exact a sort of safe, fair market that everyone can have confidence in. And this model works out very well, so well that across the world they adopt strategies and standards that the exchanges like to have in place, of course, approved by the CFTC and the NFA, that they work together. So, getting to the utilities and how they hedge, it's important that the strategy that is sort of undertaken by the organization. Okay, we just talked about governance. We talked about enterprise risk. We talked about more of a holistic, engagement with other parts of Treasury. And so within that, there are sets of strategies that can be pursued. And in my experience, what I've done is develop the strategies of working with everyone in the Treasury function in terms of what was expected in terms of volumes and forecasts, and we developed several different types of strategies that would address certain concerns and certain needs. And so the idea is that we wanted to not just put in place a hedge and then just walk away, and whether it be a futures contract or an option contract. What we wanted to do was establish, what kinds of risks are in the market and what sorts of volatility are we dealing with, and how can we best defend this market volatility, and what should we be striving for in terms of the ultimate cost to the customer. Okay, so what we were concerned about, which would be the same as your utility would be concerned about, would be the upside costs. Okay, and so what we had to do was establish what tolerances do we have. If we purchase commodity at a certain price, what is the outcome here for the customer? Okay, and really, what is it going to take to get to a level that's really acceptable and achievable for the customer? So we undertake what we call defending upside cost tolerances, and an example of that is that we'd engage in long futures contracts on commodity purchases. So by doing that, we would lock into a certain price that we could then forecast and deliver, that would be the price. Another possibility that you could pursue is one where you establish a forward risk. You establish, okay, what could possibly happen in the worst case scenario, and say, well, if the market's really volatile, at what level do we have to just make sure that our commodity price cannot exceed this level, and in that case you could continue to work with the changing factors in the marketplace, but establish a level, and in this case it would be a strike price at which the market that you would be reimbursed for any prices that go above a certain cost. So, and that can be achieved using an option contract. And that has been a strategy that has been very acceptable to corporations as a means of what we call disaster protection, is that you look at the market risk, you see that there's volatility, and you recognize we really need to keep our commodity cost at this level, nothing higher. So you can do that in two ways. That is engaging in a long futures contract on commodity purchases, or by setting a call option strike as what I call a high strike. That is the most that you could possibly tolerate as disaster protection. But the worst thing you could do is not do anything. That is that there needs to be hedges in place to mitigate risk relative to the tolerances that are set in the risk appetite. So this is, it's more dynamic in terms of the strategy. It's just the continuing monitoring of the marketplace and putting in hedges as you would work with the strategy and establish what that risk appetite is. So here's an example of when we consider what some of the sort of trade-offs here. When if you're concerned about how much you're going to have to spend to, let's say, execute a futures or options program, we've got to consider what's really a consideration for how we serve our clients. Well, customer bill increases are obviously an enormous concern. Okay, and you've got a certain amount of market price risk, and then you also have costs that are associated with hedging. So they're trade-offs. So in this diagram where we've got the three confluences, you've got the red and the blue triangles that sort of share with you what happens if, for example, if you have a higher bill increase, customer increase of your bill is much higher, it usually means you're not spending very much in terms of confining your out of market potential or the cost of the options, let's say, or costs of a futures contract. So the less that you're willing to address the risk, the greater the likelihood that you're going to forego the concern of the customer bill increases. But if you look at the red, or looks more pink here, if you look at the sort of the reddish triangle here, that is where you would be willing to do more to control the out of market potential, volatility, as well as maybe spend more on the options in order to control. And you see how you can bring down the exposure to the customer bill increases. So, this is just a conceptual way to look at, what has to happen in terms of, dealing with the sort of how you want to control bill increases for utility is through, a program that is ultimately there's going to be some out-of-pocket costs to execute on this plan, but it's what makes sense in order to achieve that strategic goal, and that is the governance of a program. So would have in place, that a risk management program would have in place. So here's an example of crude oil, where crude oil contracts are being traded. And this is what we call the most upfront contract, and you'll see that's the September 22. If you look to the far left-hand side, the September 22 contract, so top line, and it's quoted per barrel of oil, 95.62, and that the change was just the day's trading. But you see the kind of transparency that the market's providing here. You see there's a great deal of volume traded because it's going to come to maturity in just a couple weeks. So, but notice on the left-hand side, you've got a September contract, an October contract, a November contract, a December contract, January, February, March. Okay, and look at the prices. It goes from 95 down to 89. Okay, and so the reason I point this out is a couple things. First of all is price transparency. Second of all is that one of the strategies is to engage in a futures contract, subsequent months, month after month, as a means to drive down the costs, because you're going to see these futures prices, rise and fall, and when you can lock in these lower costs, you do so. So you can see that March deliveries are at 89.17 a barrel, and having that information available to you first does two things. One, you can forecast with greater certainty as what the cost of that commodity is going to be. And it's not, I'm giving you the example here of crude oil, but this type of information is also available on a variety of other different energy-related commodities as well, including low sulfur diesel and some of your renewables. And so this is just, again, a chart of the crude oil contract, and you can see this just happens to be the summary page. I did a screenshot. This is available on almost any business website. I think I took this from Yahoo Finance, but you can see that it shows not only what we call the futures market, but it also shows the historical data and the amount of activity and trading that is available. So lots of great information and data in order for utility companies to establish, strategy around getting data from the marketplace about, in terms of narrowing what that risk appetite is and putting in place a program then that's realistic based on where these prices have been. So just considering the strategies of utility companies, that they start with a risk management plan, and that has to include how to respond to changing risk metrics as they unfold. And risk metrics are the volatility that happens in the market, and then there's metrics that measure that. There are ways of hedging this volatility using futures contracts, so they can conduct their business with greater certainty as what those prices are going to be, and what can they expect to pay for commodities going out 4 months, 6 months, 12 months, 24 months. And so the idea is that the utilities can utilize these instruments and forecast faithfully what those prices are going to be that they're going to pass on to the clients, to the customers in the market. So utilities need to simultaneously and continuously look at the price risk of the marketplace and what the hedging, what the hedging costs are going to be. And the hedging costs need to be weighed against really the benefit of that risk mitigation. And given the volatility that there exists in crude oil markets and just really energy markets generally, that it's worth your while to consider, what those costs are, not just the hedging costs, but what the costs are of the risks of not being hedged in this market. So the Institute for Financial Markets provides a number of free information about the marketplaces and how they work, and there's a number of these videos that are available that I encourage you to take some time. These are nano videos, so they're really short snippets, and you can learn a lot just by visiting a number of the videos and become more familiar with some of the marketplace, some of the language and the way that the marketplace works. And then there's also more in-depth courses, and the fundamentals of futures and options is one that I teach. Coming up, we'll have an energy derivatives trading boot camp. We teach a class called Clearing 101, where we're looking at how the exchanges work with clearing houses and how they can sustain the confidence in the market. And then we're also looking at what sustainability looks like in the derivatives markets. So The Futures Fundamentals is a free educational resource, and that's funded by the CME, the IFM, ICE, the Intercontinental Exchange, the FIA, and the NFA. So that's futuresfundamentals.org, and that's another course that you can use. So that concludes my part. I'm going to stop sharing, and I'd really like to open this up to discussion and any questions that you have about how these markets have worked and really what you think of the information I just said. And you have any, does some of this resonate with you? Are you familiar with maybe some of the hedging that has taken place at your utility?
Well, thank you so much, Marty, for your presentation. And I do have a couple of things I wanted to bring up and some questions I wanted to ask. But first, to your question of our utility history on hedging, I'm not quite sure what the adopted policy is. The utilities on Guam are both autonomous agencies of the government of Guam. And so they are technically still government entities. So profitability is secondary to making sure that that price, as much price stability, as much price predictability, lower prices in particular, are able to be achieved for our public. I recall, and I'm not quite sure of the date, I believe it may have been around 2014, when there was a period where the oil price was dramatically increasing. And I believe our utility, and this is all secondhand information. I didn't have any documentation in front of me, but my understanding and communication with some individuals at the time was our utility was writing puts and using the premium to buy calls to try and hedge the rising fuel price. And what happened was, I think things reversed dramatically within a 12-month period. And I believe the figure was around $78 million that our utility lost, which is dramatic for an operation of our size.
Oh my!
And I think that what might have happened after that, and I again, this is all anecdotal. I'm basing this on secondhand information. I believe that kind of scared off the utility from engaging in hedging strategies altogether, and thus we kind of suffer the consequence now of the utility having to eat losses when fuel prices go up in an attempt to try and contain consumer costs. And then when the pain becomes too difficult to bear, they come back to the public and they say, okay, we need to raise the utility rate, and that utility rate is going to go up by X over Y number of months. And of course, we have a very unhappy public at that point.
Yeah.
Engaging in a proper hedging strategy, I think will help to levelize off our liquid fuel cost component. In the utility bill that I gave you as an example, the LEAC was $205 on a total billing of $337, a 60%.
That's crazy. Yeah.
Liquid fuel charge. And that's what I wanted to ask. Is that crazy? Yeah. And if that is crazy, what, based on your experience, what was your experience working with the utility that you worked with and engaging the strategies you shared, and how the ratio of liquid fuel cost to actual total billing costs, and just give us some insight on that if you could.
Sure. Well, first of all, I have to tell you that the collar that the utility used in 2014, that collar, that's not a hedge. Right. It's because the hedge would protect you from volatility, and the volatility you were concerned about was on the upside. And so that tells me that there was really no strategy, because the risk governance of enterprise risk management and risk governance of the utility would have said, wait a minute, we can't sell the put, because then we could get stuck holding the bag, And that's exactly what happened. So what would have worked very well for them is to just come out of pocket with and pay the premium for the call, which creates a cap to the price. And yes, you pay for that, but a couple things. You can keep the cost of that cap down by having a shorter term, like within 12 months. These options should not be going out more than 12 months. They should be very short-term options, because the longer they go out, the more expensive they get. And all you have to do is roll them. That is, you just roll them in several month increments, as opposed to buying them in a long zero pay high premium. The other thing is just to establish what is that strike that you establish a tolerance. We can't pay more than X, because we're just going to pass too much money on to our customers in terms of their energy bills. So the idea is that that you can control and forecast by putting in place those caps. The other thing that I did not mention, but is available to you, and it was available to our utility, and it has been just supply contracts where the supplier is willing to fix price over a period of time. So now what happens where and the IFM has done work with Defense Logistics, and that is something that they do, is that they have a energy company that gives them a fixed contract. And what that energy company does, that supply company does, is they're the ones who are hedging their exposure, and then they pass on the benefit then to the Defense Department. And that's another means of addressing it. And we had many of these supply contracts, but they were not of such large volume, at least for Washington Gas. They were significant, but not the vast preponderance. So we were buying natural gas on the cash market, but using derivatives contracts to control the price, so they would offset any price volatility that we'd experience. And we happened to be involved in the marketplace when we also had volatility, because fracking came along. The gaining natural gas through that fracking process really drove prices down. So what happens when you lock in prices up here and all of a sudden they go down here? So there's that's always a risk. But if you don't go out too far in terms of that strike, that is one means of really controlling the cost. As a percentage of the commodity cost, we'd pass the costs on directly to the customer, but we would, the market price that what we would pass on to the customer was never, it was always within a range, so that we were never increasing the prices of their energy bills. Their energy bills were always a constant, and we just strived for and we also had funds and reserves in order to buy down the cost to the customers as well. So those were the means in which we would control those costs. So there are a number of exchanges that are in the part of the Pacific region from which you could take delivery in the Pacific. And so I think there's different opportunities for you. I noticed that the utility did have an agreement with a Singapore organization that was providing energy commodity for a while, but I hadn't seen anything more up to date on the website about whether those contract agreements still exist.
I'll go ahead and pause and yield to my local lawmakers. They're the ones who I wanted to make sure we made the presentation available. And so we'll go ahead and pause and allow any of them to have any questions or any kind of comments. Go ahead, Senator Paris, Sabina Paris.
Thank you so much, Congressman San Nicolas, for hosting this informational session. But yeah, thank you for the presentation. I just have this is very interesting to me. I'm practically new, so I apologize if I ask any questions that are pretty obvious to you. I guess some of the questions that I have, so I know Congressman San Nicolas mentioned that GPA is a government-run utility. And how does this differ when we're working with, I guess, how has hedging policies proven to help reduce utility costs? I guess that's my first question.
Because using, well, first of all, if you establish a risk management strategy where you decide what your forecasted prices are going to be, you can use a futures contract then to lock in those prices for future delivery. And so that's how a hedging strategy works, is that there's a contract in the marketplace that you enter into that is at a certain price. So you saw prices on crude oil contracts that were just presented, and that's from the exchange. And so that if you wanted to achieve, let's say, a delivery in October or November or December for a certain volume of crude oil, that would be the price. And regardless of whether the market goes up or down, if you're engaged in a futures contract and you are arranging for delivery of a certain volume of crude oil, and that will be the price that you get delivered, so that the futures contract permits you to achieve whatever that quoted price is today for future delivery. And you saw how those prices stacked up. You had a great deal of volume in trading, so there's a lot of liquidity in that market. And also you have, and you could see that, that the prices are going down. In the forecast, those are the market prices for parties that are buying and selling. And I just showed you the next 6 months, but there are many months beyond that are also listed. I think that contract goes out 2 years. So you could see for the next 2 years that you can lock in the price of crude oil for many months into the future, and then you know exactly what you're dealing with in terms of cost. So that's what we strongly recommend. Otherwise, you can get whipsawed just by the volatility in the market, and no one was prepared for what was going to happen with the Ukrainian crisis, and and the kind of pressure that put on global oil prices. And so if you're not hedged, you're paying for that volatility. And so the futures markets permit you to address that proactively, so that you're not subject to these wide-ranging swings in prices. Now, so I just showed you the futures contracts, but the other thing that you could do is you could enter into like these caps. So you can set a strike price and say, look, we're not going to pay more than X for crude oil, and you can exercise that contract should the price go above that strike. And that's also a very effective way of achieving that locking in that price, keeping it down from lower from what otherwise the market would deliver. So, but good question.
Thank you. And if I can ask another question regarding, so as far as the interplay with renewables and the use of fossil fuels, do you see the price of oil increasing as a result of that?
I don't. I think that it's interesting. I think that our dependence on fossil fuels is reducing because of the trend towards sustainable and renewable energy. And we just passed a huge piece of legislation that is forwarding climate initiatives to help advance use of renewable energy. And we're also seeing a carbon market that has become much more liquid, and that is showing that companies are taking, that carbon market is a good indication of the steps that companies are taking to address climate change. So you buy less carbon emissions if you are taking, because those carbon emissions offsets are what companies are putting in place in order to offset the pollution or carbon that they're emitting. So they don't have to buy as many of those if they reduce the amount of carbon that they're putting out into the atmosphere. So consequently, the markets are saying, look, it's going to cost you more the more that you are involved in burning fossil fuel. So the tendency now is really to drive down your cost of fuel, because the cost of fuel it's not just the cost of the energy itself. You have to take into account the amount of carbon emissions that are being produced by that source of energy, because that adds another cost factor. So we're all striving to get to net zero carbon emissions by 2050 and sizable reductions by 2030. So in answer to your question, I see ultimately the price of fossil fuels going down because the demand is not going to be as great as renewables become more and more what companies want to depend on for their energy sources.
And as far as the vast majority of U.S. utilities, do they employ hedging policies?
Yes, they do, and they need to. In fact, there's a lot of good information about how utilities hedge by academics and consultants, and it's really the way to go. It's a part of the enterprise risk management of the organization. And it's the responsible way of running the utility. You have to have a means of controlling the cost, and you should have something in place to control the costs. And I think that in working for your constituents, that if you can oversee that your utility takes steps towards controlling the price risk, and puts in place strategies as opposed to just, the example that the congressman provided, that demonstrated that there wasn't really a risk policy. And by the way, I did go to your website, to the Guam Power Utility website, and I didn't see a risk management strategy there. I saw a number of strategies, but no, a number of policies that were there, but there was no risk management strategy, and there needs to be an enterprise risk management strategy in place. Maybe they have one, but if they're not hedging, they're certainly not taking into account an enormous amount of their risk that they're now, that is their burden, and it's the burden they're passing on to the customers.
And maybe one more question regarding regulation. So you've been through the industry where you've seen many, drops in prices, such as the housing market, the housing bubble that burst, as well as the energy market as well with Enron. So what has changed with regulation to protect the consumers?
Oh yeah, the changing regulations does a few things. First of all, it creates transparency. I mean, there was a time when these markets were opaque and it was controlled by dealers, and then they weren't showing what those prices were. And so the regulations, by having exchanges that are making that data, that information that I just showed you on that slide, that's free to everyone in the world who's got an internet connection. They can go and see what the prices are for a commodity. So, and you can at any one of these exchanges that trade a commodity that is appropriate for the power industry on Guam. So there's the transparency as well as the availability of these the hedging contracts and the likelihood that they'll clear, which is a AAA credit, is a market utility, and all of these positions, if it's a futures contract, it's margined, and if it's an option contract, well, you pay premium, but whoever sold you that call option will have to pay margin to support it, so that you've got a guaranteed settlement on any contract that you have. So that's really advantageous for the confidence that these markets create.
Thank you so much for those responses.
Sure. Tilo?
Oh, hi, it's Tello Hafade from Guam. Thank you so much to the IFM group for being here, but most especially thank you, Congressman San Nicolas, for providing the information, being very transparent, and providing the need of the crisis that we're having here with our power rates. I do know that GPA has been very cautious in implementing, buying stock. They've done it once before where they have bought, their stock waited for like 6 months, 7 months, and found out the prices had gone down and they could not avail themselves of any type of discount. So are you starting to see a trend here where, it's not a trend, well, I'm starting to see a trend of it going up and down like this, but when do you start seeing it start to taper off, that we can be more confident in purchasing, in bulk, rather than, just being cautious?
Well, I think that it's impossible to predict the future,
Right.
for any of these commodities. So the only way to protect the organization and its overpaying for a commodity is by working with these contracts, and I'd say that given the volatility, your best or one of the strategies, I shouldn't say the best, but that maybe the best strategy for you, until you weigh other, you look at supply contracts and providers and just in terms of managing your inventory. You can do that in a couple ways. One is deciding what that strike price is like. Look, we cannot pay more than X number of dollars for our inventory of commodity, and just establish that and always have a cap in place. I mean, that would be a start. The other thing, yet another way, is by structuring, and this is what we did at our utility, is that we did. So we called it the summer fill. Okay, the summer fill starts in March, and we start buying natural gas in the futures market, and then May, June, July, August, September, October futures. So we're taking in more and more every month, and with each month, the price is going down because it's the summer and it's hot. No one's using natural gas. So the prices really go down, but we begin filling, and the reason and the same thing can be done for crude oil and any other commodity, is that what you'll find is over the series of time that there's a blended price, so that if you have sort of like dollar cost averaging, so you're sort of like every month you're in the market. So there are going to be months where the market's high and months where the market's low. But for us, with natural gas, we've found that it's just deploying our purchase strategy when the demand for natural gas is really low. So, but for power, which is more constant, and if you're looking at oil, there are so many influences that create the volatility of oil. And I mean, who could have predicted the Ukraine, right? So, fortunately, we're starting to see prices come down, and the volumes you have the Organization of Petroleum Export Countries, OPEC, and they are the primary drivers of the global oil prices in the market. So that and just a tremendous amount of demand that's taking place because of the fall off from Russia.
Okay. Well, thank you so much for that. That's very informative. I guess I'm looking for that genie in the bottle to tell us, what we can do to save some funding here when it comes to stockpiling, our gas. But again, appreciate your time. I know it's in the evening there. And Congressman, again, thank you so much for keeping us informed and allowing the opportunity for us to ask questions. Appreciate it. I have to excuse myself. We have a session soon. So.
Okay, good. Okay, good. Mm-hmm. Okay, Senator Clint Ridgell.
Yes, thank you. Thank you, Congressman, for this opportunity to meet and discuss this issue. This is something I'm particularly interested in. In the legislature, I have oversight over the Guam Power Authority, and so power rates has been an issue I've really been working on as best as I can. And it's a very complicated issue, so I do appreciate you guys taking the time out today to share some of the information with us. I think we do need to hear from GPA somehow and the CCU to weigh in on this, because I don't have all of the most recent information either. Just as the congressman was saying, I'm not sure what they're doing in terms of hedging. I do know that what I remember is the entire intent of the LEAC, which is, stands for Levelized Energy Adjustment Clause. The entire point of that was to sort of levelize out the energy costs. And the whole intent was for them to purchase fuel in bulk, of course. And my understanding was they were supposed to be purchasing futures and locking in that rate for a certain amount of time. And I believe that's why they do revisit the LEAC every 6 months, because the idea is they're supposed to try to lock in a rate at 6 months. I know that they were employing some hedging tactics when they first started it. I don't know what they're doing now. So that's why, like I said, I would like to hear from them exactly how they're going about purchasing fuel and what sort of strategies they're using to hedge against the volatility of the prices. I do know that, in recent years, I think it was last year, they did claim that they had under recovery. So they were saying that my understanding is they were still trying to hedge. They just hedged their bet inaccurately or something to that effect. But I don't know exactly what sort of strategies they're employing in terms of purchasing of fuel. So that's definitely something we would like to hear from them. I've been coming from this issue from a different standpoint. Since I ran for office in Ghana, I'm a big proponent of renewable energy, and I've been pushing renewable energy for me as the biggest hedge against volatile fuel prices is to lock, because renewables can be locked in for, of course, a long time. And right now they're far cheaper than fossil fuel. And I did note you mentioned that your feeling is that fossil fuel prices should drop as more renewables increase because of the less demand. But I'm a little bit skeptical of that based on a couple things. The U.S. Energy Information Administration, their projections, I believe the most recent projections I saw show just sort of fossil fuel growth just continuing into the far future. That's based on what they usually say in their reports, is that they see as fossil fuels get more and more difficult to extract, then you'll see increases in costs as you have to go farther and further offshore to drill. Mm-hmm. Countries are using up their reserves. The U.S. just had to tap its reserves now, right, to make up for some of the problems with supply. And as you mentioned, OPEC controls supply and demand, really. And so, whenever there's an issue, like I believe recently with the Ukraine issue, the Biden administration was asking the OPEC nations, please increase the supply. And they said, no, thank you. We'll wait. We're not ready to increase the supply just yet. Yeah. We'll get back to you on that. So they artificially control supply and demand. In fact, right now we have more renewables around the world than ever before. So you would think that should lower the demand and then of course keep prices down. But if they artificially control supply and demand, they just, when the demand is low, they just produce less oil so that they can keep the prices artificially increased. So that's another thing why, that's another challenge. That's why I push for renewables, because I think we can just cut them out completely once the entire Earth is 100% renewable energy. And, once Elon Musk establishes his colony on Mars, I'm just kidding. Of course, that's, Musk's vision for the world is 100% renewable energy. And I agree with him on that. I think that's the way we need to go, not only from a price standpoint, but just from a technology standpoint. It's superior technology. So I think we'll get there eventually. But in the interim, I am very interested in ways that our particular power authority and our Consolidated Commission on Utilities can keep costs lower for our fuel costs while we transition to renewable energy. And I know there's going to be some differences here. You mentioned how natural gas is often used. That's not a component we have on Guam. As I'm pretty sure you must be aware, we're only using oil. There are plans to include liquid natural gas once a new power plant is constructed. They're building a power plant in Ukuru that should be a combined dual combustion, whatever they call it, able to burn two different types of fuel. It's supposed to be able to burn oil and liquid natural gas. So the talk has been that they'll start using that to help with the cost of fuel, and sort of playing those two markets off of each other to help hedge against the cost and volatility. At least that's the discussion right now, but it remains to be seen if we're even going to be able to bring in liquid natural gas yet. I'm not sure. That's a whole nother thing. We're going to have to build a storage facility for liquid natural gas and figure that out yet.
Yeah.
One thing that we don't have to sort of be able to, one tool we don't have to use is liquid natural gas, at least not yet. But anything you can help us with in terms of coming up with ways to save costs on fuel, I'm all for it. Please help us.
Well, I think that the risk, what I talked about in terms of strategy, everyone has to be on board at the utility and in the leadership of the state of Guam. What are the strategies? That they owe that to the people. What are the strategies that we're doing? What are the steps that we're taking to make sure that your power bill is as low as possible? And how are we hedging that? And I think that's a good question to go back to the Guam Power Utility and ask them. And
I will ask them as the chair on the oversight committee. I will ask them officially if they could weigh in on this issue.
Good. I'm glad to hear that. I think that answer is going to get. I mean, your expectation that they have that. I think that will start things moving in the right direction.
Absolutely. Thank you.
Mm-hmm. Thank you. Yeah, Nestor Lecanto, is it?
Thank you. I can go up if there's no other senators. I'll defer to them. But if not, then I can ask my question. Is that okay, Congressman?
Yes, just to clarify from Marty, if this concludes the remainder of our senators, we can go ahead and transition into our media partners who joined us on the call, and Nestor Lecanto would be one of them with KUAM News here on Guam. So I'll go ahead and yield to them if there are no other senators. Okay, Nestor, I think you can go ahead.
Thank you, Congressman, and thanks for the presentation. I do cover utilities as part of my my beats here at KUAM, and I do believe that GPA does use futures contracts to manage risk. But I wanted to ask you, what would be your best recommendation for a hedging strategy for a small, completely self-contained, government-owned utility that imports 100% of its fuel?
Well, okay. So what would be my recommendation for?
Yes.
I think first of all, where is it coming from, and what's the currency? And look at that.
I believe they trade out of Singapore.
Out of Singapore. So, are they trading in renminbi? Are they trading in U.S. dollar?
I don't know for sure, but I imagine it would be in US dollars.
Okay. Well, we'd first want to make sure that we would hedge our exposure to foreign currency on the contract. And I think I would do I would do a combination of futures and call options.
Can you elaborate on that?
Well, first of all, working with Treasury, you'd have to look at the forecasts for usage, and you also have to consider contingencies. So I think I'd handle a certain larger percentage of the expected demand using futures contracts, and then a smaller portion, which would not be hedged, you would cap it using an option contract. That's how, I mean, just without getting into, knowing the detail. I also don't know whether, if they have supply agreements, what portion of the demand is met by supply agreements, and do those supply agreements have, are they at fixed price? Or if there's a variation on the price, I would employ, or I'd ask for either them to embed an option, that is, be at their cost, but put in place an option contract that would cap the cost to us as the utility. But making sure that you have a forecast, and the forecast term, we haven't spent too much time on the term, but it makes sense for the utility to also have a forecast that goes out like a rolling set of time, like every 12 months. You're adjusting to 12 months hence of what the utility cost is going to be that you're going to be passing on to your customers. So in the meantime, you're also monitoring where the world markets are, so that if there's times to lock in at lower prices, that you can, that you're adjusting to those prices that are, and data and information that you're receiving from the market.
Yeah, I think as the Congressman and Senator Rigel mentioned, that we do go by the Lee Act. It's a kind of a two-tiered hierarchy, if you will, regulatory hierarchy. GPA reports to first the Consolidated Commission on Utilities, and then the Public Utilities Commission ultimately to approve any rate increase or decrease. So, there is a considerable amount of oversight over rates, which are, as previous speakers mentioned, are very sensitive here on this island because we depend so much on fuel oil. So, and they do employ a pretty substantial contracting firms to assist them as well. So, yeah, thank you very much. Appreciate it.
Sure. Maureen, I think, had a question.
Yes, I did. Thank you very much for the presentation. Thank you, Congressman. So I'm the publisher of the Mariana's Business Journal, which covers news in the region. I wanted to ask, I haven't looked at the issue since the war in Ukraine, but you probably know there's some move internationally, and certainly in Europe in the past several years, for privatization of utility suppliers to populations. And I wondered if you could comment on the perception that that necessarily brings with it an increase in prices, because I don't believe that's necessarily so.
Well, the public utility that I worked for was also a publicly traded company that was owned by shareholders. And we were regulated by the FERC, the Federal Energy Commission, as well as the Public Utility Commission. So we had two sets of regulators, and the Public Utility Commission, we were audited by them on an annual basis, and we had to show sort of the steps that we were taking to ensure that the needs of the consumers were being met, and if there were any complaints, they would need to get addressed. And one of the examples of that was when we outsourced our call center to India. And there was a great deal of concern about outsourcing our call center to India because we, were the people that were, freezing cold in Washington without their natural gas power. Let's say if something went awry, were the people in India going to care as much as, let's say, people that were living actually in the vicinity also experiencing the cold weather? And it really did bring a great deal of controversy. But the company wanted to, it was a cost reduction strategy. And so, in answer to your question, does a privately owned enterprise are they going to be relied upon to be, as effective and, won't be too opportunistic in terms of their pricing? I think that with the regulations and the oversight that exists, that a private enterprise can effectively serve as a public utility as well. It doesn't necessarily need to be government owned. But that's just my experience. I mean, I'd be interested in hearing what other people and their experiences have been, and also whether there have been studies done about that may be influential and may change my mind. But I just know from my own experience that we really were tasked to make sure that the costs that we were trying to achieve were the best that could be achieved, for the region that we served.
Does anyone who is among the experts here have anything to add? Okay, I appreciate the insight. Thank you. Congressman, if I might address a question to you, what do you see your next step in this process now that you've brought in some expertise from the U.S. mainland? Do you have any future steps that you can share with us?
Oh, well, thank you for that, Maureen. And to echo some of Senator Rigel's statements, I believe that what we've empowered our local lawmakers with in terms of the information today, I think is an excellent starting point for us to now take that information and connect with the Public Utilities Commission, the Consolidated Commission on Utilities, and GPA to get a better understanding of what their risk management strategy is. I think Mari's observation that it not being as transparent in publicly available resources kind of underscores the need for us to have a greater level of transparency on what the risk management strategies are in the utility, as opposed to where we are right now and the uncertainties in how the cost of the LEAC is being managed and whether or not it's consistent with a proper risk management strategy. I also think that some of the conversations here have really been enlightening, even for myself, where we have an infrastructure in the United States where we have power grids that transcend small communities, and we have a financial market that takes into consideration a lot of private sector utility operations versus utility operations like ours. And our market being so closed, having different energy source providers, having different mandates in order to operate, is just more. It has an even greater challenge because we don't have as much access to the kind of expertise that we have here on the call. And like for example, larger energy companies in the States that have millions of customers have a literal division of financial advisors who are able to help them make and adjust their hedging strategies and their hedging decisions. out here on Guam, and I guess this is to answer your question, Maureen, and to also kind of just give some insight to our guests. I mean, because of our size, we have very limited even financial market expertise here. We do have some large financial market players, but they cater mostly to high net worth individuals. We don't even have a municipal securities advisor here. So let alone a commodities futures trading advisor or any other type of advisement. And I'm not just talking about working for the government, but just even living on the island. And so it becomes very challenging for us to be able to avail of this kind of expertise. And that, I think, could be a contributing factor to our risk management strategy not being as transparent as we would prefer it to be, or as robust as we would like it to be. The next moves would absolutely be to get some transparency on this topic from our utility, and then to also help them to get in touch with and procure the advisement that they need in order to properly construct one and to properly manage one. And no disrespect to our financial, our CFO up at GPA, but getting into this arena is an entirely different set of circumstances that needs expertise to be able to guide it and manage it effectively, especially given our unique conditions. And that is going to make it even more challenging for us to be able to find the right expertise, given the fact that many advisors out there are very familiar with different circumstances from ours. So yeah, those are what I would see as the next steps. I would like to, I'll continue to yield to you, Maureen, for questions, but just to put this out there for Marty and the team to address. If you can answer when the time comes, what percentage of commodity budgets are typically allotted to hedging costs? Like, for example, we have a 60% LEAC. What percentage of commodity budgets are typically allotted for hedging? So of that 60%, how much would normally be used for hedging strategies and other utilities? But let me go ahead and continue to yield to you, Maureen. I didn't mean to interrupt your line of question.
That's fine, Congressman. Thank you. I just wanted to ask if you personally, given that you are a candidate for governor, if privatization or some form of public-private partnership for our utilities, such as we see employed with the Guam Waterworks Authority, is something that you think may yield benefits for Guam?
I think that it would be really good for us to employ private sector expertise in areas where where our government institutional knowledge is at a disadvantage, and that would clearly be the case in circumstances like these. Again, no disrespect to our CCU, our PUC, our Public Utilities Commission and Consolidated Commission on Utilities, but I don't think anybody sitting on any of those commissions are versed in risk management and hedging strategies. And so even if the CFO, for example, in GPA were to come up with an idea or a strategy, or even if they were to consult with a limited number of third-party advisors, the ability for the CCU and the PUC to be able to determine the efficacy of those strategies would be very limited, and they would need advisors to advise on what the advisors are advising. And that becomes a confounded problem of having something entirely government-run. And so having greater private sector engagement in areas where we have government gaps and institutional knowledge will not be sufficient to be able to give us the best information for all parties involved. Absolutely, public-private partnerships are the way to go for us to be able to avail of that expertise, even if it's not residing necessarily here on the island.
Okay, thank you, Congressman. I appreciate the opportunity.
That may conclude our media partners and our senators' lines of questions, Marty. So I'll go ahead and yield it back to you. But if you guys can address that particular question, because of the percentage of commodity budgets that are typically allotted to hedging costs, because if we have 60%, 200 out of every $300 bill going to LEAC, what percentage of that should be actually going to hedging strategies?
Well, your hedging strategies, for example, to enter into a futures contract, the amount of funding that you need to sustain into a futures contract is really is the margin. So you commit to a certain level that you're going to settle that account, and that's just a part of the cost of the commodity. So when you think about budget, like how you're going to come out of pocket and actually pay for something, then you would be looking at maybe an option contract. And your option contracts don't have to be necessarily that expensive if they're shorter term and also are higher strike set for disaster protection. But I say all of this in terms of I can't just say that the answer is 5. You have to take a look at you need to look at the total budget in terms of the operations, and then consider what your strategic goals are, and including the risk management in the goals as a part of the operations of the enterprise holistically, and say, okay, within the strategic plan, these are our goals to maintain the X, as a fuel cost, and strive for a certain constant, given just to address the volatility. I mean, the volatility is the devil. That has got to be kept in the box. And we've got to just find a way to be able to commit to a price that can be forecasted as far out as you can. And realistically, we've got this 6-month benchmark that Senator Rigel was talking about. The 6-month benchmark, maybe you could do 6-month, 12-month benchmarks. These are shorter term, so it doesn't have to be extraordinarily expensive. But I'm sure that's why the person that constructed the collar, was selling the put, was using that strategy. But then you couldn't enjoy the low prices when those days came about. That's the sad thing about the put. So it's not a collar. It's not a very effective hedge.
On another question, so since you tapped into the volatility component of the subject, what level of variance or volatility would typically be acceptable over a 12-month period? What kind of variance in terms of commodity cost, 12 or 24-month period? And I know that it would be more market sensitive and more sensitive to what our typical cost structures are out here. But what just as a general sense, what? I think fluctuations are normal.
Yeah, I think the best way to answer that question, and I don't have it in front of me. Okay, I don't have it immediate in mind, but I think to answer that question, I would look at some of what the public service commissions are expecting just look to these regulators, that sort of what are the expectations that they have set for the utilities, and I could do that and share that with you and see and then in response to that, that's what the utilities are setting. It's like we can't, we cannot deliver, that great of a volatility, but to try to understand within which spectrum of change or variance that power bills can range, there is an expectation that the public service commissions have in place, that will vary from region to region. So, and I think that would be where the answer is. So I could look at that. But I know that they weigh in all the time, and they weigh in publicly in whatever region that they're in. So it would be probably pretty easy to find out. But I'd be happy to get back to you, Congressman, on that, just as an FYI.
Yeah, thank you. Because again, we've had some recent LEAC adjustments in our utility bills that have caused them to reach the utility costs out here already are at a serious pain point, way over the pain threshold, and then it just got even the wound just got even deeper with these adjustments. Also on the subject of hedging, I know that we hedge the commodity price, and then you mentioned also earlier, and I was intrigued by this, and there could be advantages as well in the locking in of the supply contracts and the price controls that come with that. But given how volatile the pricings can get here on Guam, would it also be sensible to use hedging strategies on the contracts themselves, as in to hedge the underlying commodity in the event that when the contract expiration date comes up, you know, there's some kind of massive shift in the prices that we're able to offset the contract adjustment?
That would be another great strategy, and that would be a part of the risk management. That's good. It sounds like you've been talking to other people too about this, because that clearly is another strategy. Is that when you have a delivery contract for X number of dollars, that you could actually see, okay, well, where's the future trading on that? And you know, you could optimize that. So that's a good point.
Where would be a good resource for us to get examples of risk management strategies in other utilities that have a similar profile to ours? Because, you know, a risk management strategy for a private sector, multi-state, decamillion customer utility would be very different from one for one of our size. Where would we be able to source something?
You know, I'm okay. So I'm thinking maybe let's take a look at Hawaii. You know, there's a possibility, right? And it happens to be a state, but you know, that doesn't. It's out there in the middle of the Pacific, so it's 7 hours off the coast of the U.S. It's a distance. I think that might be a one good example, and there should be a great deal of transparency there.
Right. That would also be assuming, though, that they have an effective risk management strategy.
Yeah. Well, we haven't heard complaints yet from the people of Hawaii. So, but yeah, exactly. You definitely want to do that. But you know, I think about well, you know, what does Puerto Rico have, right? So they're an island community. You know, what are they doing? So
but there is no like general repository of risk management strategies that are compiled on a nonprofit basis, for example, that we can kind of go in and comb through.
You know, I'm sure that there are. The exchanges provide a number of the exchanges. IFM has educational programs. The parties that work with the Futures Commission merchants. So, for example, the utility has if they've engaged in futures contracts, they have an arrangement with a Futures Commission merchant, and that would be a broker that enters in the contracts into the exchange. And a lot of times these brokers have expertise in a particular commodity. I mean, and they define themselves by that commodity, like they're an oil guy, you know, or gal, or they're a natural gas person, or they're an electricity person. So they really do define themselves that way, and they develop a lot of expertise in those markets. So that would be another source. But the other source is looking at management's discussion and analysis in the 10Ks and 10Qs of these public utilities that are publicly traded, because they have to explain how they go about, engaging in risk management. In fact, I wrote the disclosure for our public utility in how we went about addressing risk management. And it was great transparency. We listed the derivatives that we had in place. We listed why, what we were able to achieve with those derivatives and what the various strategies were. So that was all part of our SEC disclosure. So there's that. I'm just kind of brainstorming with you right now. So where else to go?
That's great. And just Senator Rajel, I think we might want to make that a mandate for disclosure on risk management. That way it's out there and everybody's able to find it easily. One final question, I'm taking up a lot of your time, but one final question, and this is something that when we went to when we had a presentation like this to the senators from MSRB and the administration who sought to try and fill the gap on the lack of a municipal securities advisor, I think they put out some ads in publications and we didn't really get any interest. Where do we go if we want to find expertise that we want to employ or contract to be able to provide these kind of services for our utility and for our local government? It's instead of us just kind of like casting out a hook into the vast oceans out there, is there a place that we can kind of target our a potential RFP for services or put the word out to certain associations? How can we find the expertise that we need, given the conversation that we had, to be able to fill the needs that we're talking about here today?
And this would be, you're looking for advisors to the utility to help them develop their risk management strategy. Is that right?
I think that would be an excellent starting point, and we also probably would be needing the same kind of expertise to actively manage that risk management strategy after it's been developed. But yes, that kind of expertise.
Yeah. Well, who are the auditors of the utility?
I believe it would be Deloitte, Senator Rajel. I'm just guessing because they're the only major auditing firm here that really deals with the government of Guam.
Yeah, Deloitte.
So I don't remember, but so it's that, and then of course we have our public auditor who regularly conducts audits of them. But I don't remember what the scope of his audits are with regards to utilities.
Yeah. I know that for when I was putting in place the risk management program, I had asked PricewaterhouseCoopers to just kind of look over my shoulder and make sure that what I was putting, because it was new to me at the time too. We're just trying to figure our way, because there was nothing. It was tabula rasa, nothing there when I first joined, and so Deloitte was our auditor. I asked PwC to just review what I was doing and to provide an opinion and to present to the board that what we were having in place is best practice. And so that was PwC. But I know that there are a number of consulting organizations that would be interested in this kind of work, and if still maybe Deloitte would be a resource. But you probably would want, maybe there could be a conflict of interest for their consultants. So you may want to go with one of the other firms, or even a smaller firm, one of the second tier firms that might have an interest in it as well. Maybe PwC, since they're a global firm.
But these would be auditors to kind of oversee the creation of a risk management strategy, but not actually be the ones to do the creation of the risk management strategy.
They would be They would be consultants. I know that there is an organization, it's called PFM, Public Financial Management. Their headquarters is in Philadelphia, and PFM focuses on municipal finance. That is all they do. And
yeah, we can definitely tap them because of the situation of our utility and how it's a government agency. It's just a little. It gets hard for us to be able to find the municipal finance folks, but the public financial management are definitely strong on the area of the municipal security stuff that we talked about earlier. The bond issues and stuff.
Right.
We can definitely reach out to them and ask them if they have experts to help us develop a risk management strategy given our unique circumstances. But absolutely, that would be a good resource. It's just so complicated because our variables here are so unique in our market in our cost structures. But what we want to do also is, in terms of the hedging that we've been discussing, is on a global scale. And so we need to find the kind of expertise that's able to give us that global perspective, while also at the same time factoring our very unique local variables. And that kind of blend of expertise is going to be very hard to find. It's obviously going to require multiple experts at the table, at least in the initial development of the investment risk strategy, and then in the management of it, having somebody there over a longer period of time developing institutional knowledge will just make us more effective on that.
Well, I think I could, Congressman. I could think of a few people that I can maybe pass on some names. Offline.
Yes, absolutely offline. And in fact, it may be more appropriate for those to be communicated to Senator Vigel, just in his capacity as oversight chairman. That way, we have that arm's length situation here, where our office is simply facilitating the discussion of the topic, and then between the local government and you folks are able to get into greater detail on what actual options are out there.
Sure.
Yeah, that would be great. I'm sure the Senator would be more than willing to take in the potential recommendation.
Sure. And I can circle back with your office or Senator Rigel if we have your contact information. Email address be fine. Well, I would be happy to follow up with you. Okay, so I
might have frozen there.
Yeah, maybe.
We'll talk about timing. Anyway, folks, thank you so much. I know that again it's late on your hour, but these kind of informative sessions for local lawmakers as well as for our local media, I cannot overexpress how valuable it is, especially for communities like ours. It's just so challenging. And so the time that you've put into the presentation and the time that you've put in to be here with us today to give us the guidance that you have and to answer the questions that you have, again, I cannot overexpress our gratitude for all of the efforts that you have made. And we look forward to continuing to engage as we delve deeper into the guidance that you've given us. But it's been so enlightening even for myself. And again, I'm on the Financial Services Committee, as you're aware, so we see all kinds of stuff. But this is definitely something that has been very enlightening for myself. And so thank you so much for making the time. Marty, Trish, and Kyle, you guys are awesome. Thank you so much.
Oh, thank you. It was an honor to talk to you and to talk to your colleagues in the Senate and the press as well. Thank you very much for the opportunity too.
Thank you too, and just thank you so much.